Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Many things were playing out in the economy when the tariff shocks hit. One of them, importantly, was personal income growth. Consumers were in growth mode. And our next guest likes to remind investors starting points matter. If corporate earnings were reaping the benefits of a fit consumer, on balance, how much more could the company's bottom lines absorb than if personal growth, for instance, had been absent in the US economy? Joining us now to explore this element of the corporate earnings story and its intended connections with potential multiples growth is Head of Quantitative Strategy at Fidelity, Denise Chisholm. Hi, Denise. Welcome. Nice to see you.
Hello, Pamela. It's great to be back.
Great to have you join us here. This is fascinating, and I want to ask you about some of the things going on in the economy right now because we have some new data points. But just take us back to when tariffs hit and what everyone was earning at the time in terms of what they were feeling like in their own back pockets.
Yeah, I think everyone was worried that tariffs, once they hit, would increase the cost of goods that everybody was buying and real incomes would decline. And real incomes just recently declined in 2022. So that was a very recent event. And in fact, it was the biggest decline in real income we've ever seen without a recession, meaning nobody lost their jobs, but income grew slower than inflation. So that was the fear. But this is exactly the opposite setup than where we were in 2022. Despite the fact that tariffs have, sort of started dribbling into the U.S. economy, maybe the full impact hasn't been felt yet. But despite some of the dribbling in, what we're seeing is an acceleration in nominal income growth and real income growth, so adjusted for inflation. And this is really important because, to your point, starting points matter.
That's your point.
Is because the reason why they matter is because this is very correlated to future earnings growth, meaning that if the consumer is in good shape with a very clear tailwind of real income growth, that usually bodes very well for earnings growth over the next 12 months. So if we rewind and say, well, one of the things that we were worried about was a contraction in real income and a contraction in corporate profit growth, this might be saying exactly the opposite. The setup is better than you think, and maybe earnings revisions that we saw over the course of the last, month or two were really overdone.
So when we saw comments, and we have seen comments out of the U.S. administration, and they've been interpreted in lots of different ways. I think certain companies, particularly consumer-facing companies, told actually to eat the tariffs and not pass them on to consumers. There was sort of that discussion and debate and headlines and so on. But in fact, consumers, based on this, could afford it, actually, could afford to have the tariffs passed on at that time.
I think that's exactly the right way to think about it. Another way to say it is there's a whole lot of offsets. So yes, prices of some goods will in fact increase, but there could be offsets in other places, either where the consumer decides not to spend money or to spend money. So it doesn't always mean, and we saw this in 2018, albeit on a very, very much smaller scale. If the price of washing machines goes up, yes, that's going to be one of the drivers into goods. But the prices of other goods and services might offer an offset. One of the key offsets for the consumer that we've talked about is the decline in oil prices. Right. So if we think back to that tariff math, we can make guesses about it, but in some ways, despite the fact that tariffs are new for us this time in this magnitude since 1930, tariffs are essentially a tax. We just have to make some guesses on who they hit and when. So the who they hit, if they hit in terms of half comes to the U.S. consumer, and we're talking about a 15% aggregate tariff rate, which is a little more than what we are right now currently. If that hit to the U.S. consumer, half falls to them, that's $250 billion. That decline in oil prices exactly matches it by about $250 billion. So back to your point, there could be a situation where the consumer actually can afford it.
So take us through then because we're sitting in the middle of the second quarter, everyone's sort of thinking that if the tariffs hit is going to hit, it's going to be in this quarter. We don't have that data yet, but we sort of assume some version of it is taking place. Again, that said, your starting points matter. So take us to the earnings story, because we spent time with you. You've shared your data with us on earnings estimates dropping And then ultimately, we've seen stock markets come back. So we're sort of asking about that earnings story, knowing that we're in the second quarter, which could reflect the tariff turmoil pretty seriously. What do we do with earnings estimates and therefore with stock prices?
Yeah, it's funny. So as soon as the reciprocal tariffs were rolled out, what you saw is a decline in earnings revisions. And this is revisions, so it's a diffusion index, not growth rates, but a decline in earnings revisions that you've pretty much only seen in prior recessions. So as soon as the reciprocal tariffs were rolled out, everybody took pen to paper and said, taking numbers down. The problem is once you do that, and the market reacted quite quickly, remember that peak to trough was bear adjacent, right? So we didn't go down more than 20% on a closing basis, but we did on an intraday basis. By the point at which numbers come down, it's usually too late. So you can't wait for that sort of earnings shoe to drop. And now herein lies the big rub. So we just highlighted the fact that real income growth is in a much stronger and much different position than 2022. A lot of the soft data or the surveys that I watch that have been predictive, like the Philly Fed, have staged a really strong comeback. So all of a sudden, all of these things that are good predictors or good corollaries to earnings growth have bounced back a lot stronger than you think. So again, it sort of sets the stage for what if that downside in terms of earnings revisions was just overdone, which is, to your point, part of the reason, and I think the rationale behind the upside in stock prices.
So the upside in stock, take us there, because it does feel like, well, maybe that's taken place. Like there was a V shape and we're back up here. So get us into the multiples so that we can ultimately sort of figure out where we go from here. It kind of feels like we've come back and, we're back at these all-time highs and so on. Multiples are back.
Right. So did I miss it? Right.
Yeah.
The big question, did I miss it? So if a 20% decline essentially priced in 2/3 of the way or 70% of the way through to a recession, did the snapback already price in the recovery? That's faulty and risky logic when you look historically. And we don't have to go back very far to take our learnings or to study history. 2022, right, at the bottom where we saw now, 2022 did fully price in my opinion, this is Denise Chisholm's math, did fully price in a recession. We had a peak to trough decline of the S&P by 30%, and we had defensive sectors rotate through what you traditionally see in a recession, 100% of the way there. So given that we saw that, despite the fact that stocks did snap back from that low, given the fact that a recession did not ensue, what you saw was stocks went up 65% over the next 2 years. So that's the price that you might end up paying for being wrong when the market actually prices in a recession that doesn't happen, meaning that don't be too narrow-sighted when you're thinking of market snapbacks. And the reason and the math behind this is the trickiest part. I just met with a client who said, Denise, you know a lot of probabilities, you talk through a lot of math, but that's a lot of numbers. Can you just make it really simple and boil it down to what do you think earnings are going to grow? And what do you think the multiple we should pay on it is? And the reason why I almost never answer questions in that framework, because if I did, it sounds slightly insane. So remember that when earnings growth contracts, what you usually see is a higher multiple, not a lower multiple. Multiples actually cushion the blow when earnings decline. So I could really tell you that the clear math, and anybody who's interested can check it out on my LinkedIn, the ranges are very wide for each earnings growth trajectory and what multiple you have paid on it over time. If you start giving us credit because corporations are twice as profitable as they were in the 1990s, if you say, well, I'm willing to give a 60th to 75th percentile multiple of that range, you end up in a situation where a 10% earnings growth contraction and a 30 times multiple puts you in a price target perspective 25% higher than where we are right now.
Whoa, okay.
So that doesn't sound particularly rational, but that is the actual math, which is why instead of putting pen to paper and doing earnings growth and multiples, I usually look at the probabilistic setup to see the patterns, because you could be wrong on both by a very, very wide margin.
And does this go back? So you're connecting companies being much more profitable than they were 20 years ago. Well, why is that? I mean, what is that, an efficiency thing? We keep getting told we're actually quite inefficient, but
Right. It's definitely an efficiency thing for corporate America. I'm not quite sure that all of the employees are as efficient, but corporate America is much, much more efficient. And you can measure it in a variety of ways. You can look at the NIPA corporate profits from the GDP accounts, which includes all the small businesses. That's seeing an uptrend, especially since the 1990s. You can look at certainly the mix shift into technology, which has higher operating margins, show you that margins are much higher, but you can even exclude technology. Look at the rest of the equal weighted sectors, and you'll see the average energy company, the average consumer discretionary company, the average consumer staples company, all are more profitable when you look historically. And that has a really strong corollary to multiples. Right. So, yes, multiples correlate to a lot of macro factors, but they also correlate to profitability. So, you are willing, as an investor, if you think that profits are more resilient because margins are in an uptrend, to pay more for those stocks. And if we give that the benefit of the doubt, then it could be that multiples are just going to be higher than you think. And potentially the higher for longer that we're worried about with inflation and maybe even the Fed, the higher for longer might actually end up being multiples.
Wow. Because a little inflation is always good for equity prices.
A little inflation is not a bad thing.
It's not a bad thing. So if you go from that discussion, let's take it into the sectors, because you'll often hear on various people's math that the Mag 7 or even a broader look at the tech sector, they're actually underpriced in a lot of ways for all the reasons that you just mentioned there. And it seems eye-wateringly hard to believe because they got to such heights, they've come down, they've gone back up a little bit. This is all in the tech sector, but take us there, because you do hear an awful, this is not a bubble as it was in the early 2000s, because the companies are simply making more efficient, and they're just worth more.
I think that's exactly right. So the free cash flow that these stocks are generating, that these companies are generating, and by companies, I mean the aggregate technology sector, is just more sustainable and more durable each time we look at it. So even in the bounce back that we saw in terms of technology outperformance, the stocks, in fact, from a sector perspective, got cheaper because relative earnings were stronger than I think people expected them to be. Meaning, even in all of this volatility, the market volatility, even in all of this uncertainty, what you're seeing is very durable earnings growth. And that's how you end up in situations where the stocks can stay expensive for longer than you think, because mid-cycle earnings is better than you think, meaning that when we look back in hindsight, potentially the stocks were cheaper than you thought because you got mid-cycle earnings wrong because earnings growth was more durable. I think that looks to me like the pattern in technology stocks right now.
Which is, so take us through the sectors briefly. We'll swing back around to that. But technology, last time we spoke, was your top within the sectors.
Yes, without a doubt. Technology is number 1, 2, and 3. But if you want 2 and 3, it will still be financials and consumer discretionary. I think financials, from a risk-reward perspective, especially in specific areas, still is viable in terms of that downside protection that you traditionally see in terms of bottom quartile valuation levels. I think within financials, the most interesting to me, because there is more fundamental improvement, is in brokers and capital markets. So that sort of stock-centric area, where it was, I would say, before the correction was more bank-based and more across-the-board financials. I think this now, given the correction that we saw in that bear market adjacent math, is much more capital markets, equity-centric exposure that I think is the opportunity in financials. And consumer discretionary looks the exact same as we talked about. I mean, Tesla sort of dominates in terms of the percentage of the market cap weighted index. But there are a lot of other companies that do have really strong valuation support and do have really strong free cash flow trends, so much so that they're cheap on it.
Wow. So Tesla is a consumer discretionary company?
It is a consumer discretionary sector.
Yeah. So it's hard to know. It straddles that very well. If we can go to some of the economic data, just what it seems to be giving us, or what it portends to be ultimately. I mean, today we saw a little bit of softer inflation data. There was a jobs element, though, to some of the data today. I'm just curious, if we go to the Fed, go to what they're wrestling with, what they're trying to weigh against one another, what you think. They're on hold at the moment, as we know.
Yeah, and maybe that's appropriate given that the level is important as well, right? The Fed doesn't need to move if the level is, quote, appropriate. Now, when I look at real interest rates, it always depends on what you deflate them with, right? So if you're talking about where the Fed is or where the 10-year is, what inflation rate do you want to discount it with? I tend to lean on trailing inflation, actual inflation, not inflation expectations. And mostly because I think that market based measures sometimes prices in recessions that we don't end up seeing. So I'd rather end up using actual inflation. When you use actual inflation, you look at either the Fed or the 10-year Treasury, and you look at it relative to history, you go, geez, it's not particularly elevated. There's not a real reason why, especially the 10-year, that you would say that there's so much pressure in the aggregate economy that they need to cut. So I do think that when they were higher, when it was more like 5.5, that was a situation we ended up being in. Hey, if inflation isn't nearly as bad as we think, then the Fed is too tight. I'm not sure that we're in that situation currently, at least my read of the economic data. So when you look at that through time, what you can see is if it's not urgent from an employment perspective, it's not very clear to me that the Fed needs to act and can potentially wait for inflation to come in lower or to be lower than they expect. Although that said, that's exactly what's happening in the most recent data, which is not to say that the tariff effect won't come in over the next couple of months. Some of the reason why you haven't seen it bleed into the headlines is because there was big purchasing beforehand, in which case the consumer could be protected for some time. But the more time that it takes to see the tariffs come in, the more income grows during, the more offsets could build up, and the less systemic it will be. So the longer that it takes to see inflation in the headline indicators, to me, the more likely the Fed can cut in the second half of the year versus has to cut in the second half of the year because employment is so weak.
But if the tariff factors or the tariff inflation essentially does come in, are they not in a position then to have to consider hikes again?
Hikes, so far, they have not sort of mentioned hikes on the table. They have said we'll stay where we are. Some of the Fed work has come back with a lot of the similar work, I think, that when people study history come up with, which is to say there might be a tariff impact, but it actually might be transitory, not to use that word again. But usually what you see is, again, tariffs are a tax. So if the consumer doesn't have any more money, then you could end up in a situation where it happens in one given month where incomes don't grow into it. What you could end up seeing is, sure, I have to pay some higher prices on goods, but given no more money, my marginal propensity to consume is declining in other areas, and you will see pricing power decline in other areas to offset that. So I do think that the Fed is coming out with basically the same framework, but it's just over a longer term. So it's unknown what we will see over the short term. But to the extent that you have a longer time horizon, I think that they are willing to sit and wait and look at the data.
Yeah, it's so fascinating to sort of see how what they're doing is shifting a bit, but it's always been a bit of when the labor story comes in to perhaps force their hand in some way or the other. Can we talk a little bit about credit spreads, what they're showing you today? There's lots of discussion of auctions going on, whether a 30-year is or isn't as useful as it used to be. But if we look more specifically at credit spreads and what you use them to indicate in most situations for the equity markets, is there anything there to either worry you for a melt up or a fall down?
In some ways, the worry would be the melt up. This is one of the quickest declines we've seen in credit spreads, I think, in the data. And I was just actually looking at it before I jumped on here, that we have seen, I think, in the better part of 20 years. So this is not the setup that we saw in 2022 or even during long-term capital management in 1998, where what you saw was a spike in credit spreads with the credit market saying, hey, we got to be careful here. There's going to be bankruptcies. There's going to be sort of more sustainable impacts to the overall economy. And those credit spreads stayed higher for quite some time, overshadowing that certainly in 2022. We are not seeing that. With the rollback of the tariffs, what we saw in terms of reciprocal tariffs maybe being 30%, now it's looking more like half that, maybe 15%. Again, back to the timing matters, starting points matter. This might all end up being rolled out over 6 months, which is less systemic. All of a sudden, this looks much less impactful to the credit market, and the credit market is back to bottom quartile levels. What do bottom quartiles levels mean historically? They mean higher equity prices, not lower equity prices. So if you're looking from a daily signal perspective, what you're seeing in the credit markets is saying, look, I think that there's not a lot systemic to see here right now.
Given the lower stock multiples and higher jobs data earnings growth expected to boost equities, maybe you don't agree with that, but in any case, higher job data is earnings growth expected to boost equities versus lower bond yields? I mean, yeah, there's a question there. Yields have come down a bit today in reaction to some of this.
Yes, yields have come down a bit. So to your point, I mean, I think that that's a good segue into the statistics around it. So yes, lower yields correlate to higher multiples, but so does increased earnings growth and profitability.
Right.
There's two ways to get paid in terms of multiples. They both correlate, they're both related to each other. But if you ask me, does corporate America need lower interest rates to be able to generate earnings growth, both in the empirical data, and I think what's different this time is the answer is no. Corporate America essentially turned out their debt. So it's not really vital to the profitability story. So maybe you don't get markedly lower interest rates. So that's not, your tailwind for multiples, but you still might get, to your point, much higher earnings growth or higher earnings growth than the stock market expect, which could drive multiples higher. So I do think we are in this strange position where, as much as we're not going to get a lot of good news, the struggle as investors we need to struggle with, or the data, or how to think about it, is what the market already discounted. And I think that's the riskiest part. So what multiple do you want to pay? I get a lot of PMs who want to pay, I want to pay 15 to 18 times. Don't we all? I think that that's really tough within the ranges that we've seen, given the profitability of corporate America. You just might not get there. Would it be a viable downside to the extent that you thought that we were going into a recession? Sure, that's not a bad target. But we've seen how those targets can really hurt investors in even the financial crisis. So stocks were actually, the cheapest they've been since the 1980s at one of the areas of, I think it was October of 2008. They were trading at 10 times earnings. And then stocks fell 30%.
Yeah, I know.
At that bottom of March 2009, stocks were trading at 15 times earnings. So that's the problem with using multiples as you think about earnings. The variability is too wide, which is why I end up gravitating back to this pattern in the setup. So back to the more succinct answer to the question is, we might not get markedly lower rates, but we are going to get markedly higher profitability if some of the leading indicators are right. And that might boost multiples enough that you get this double tailwind.
That is so fascinating. We didn't always have to ask this question, I don't know, even 6 months ago, but when we put the US setup for equities into the perspective that you're giving us, there seems to be a competitor, which is the international trade. And I don't know to what extent you do or don't look at that, but I guess the question is the setup in the US better than elsewhere, essentially, for equities?
It still looks to me like it is. So you've certainly seen earnings growth in EFA or Europe or emerging markets accelerate relative to the US over the last few months on tariff fears. But when you look historically, and we saw this in 2022, the market ends up looking through it and it doesn't drive sustained outperformance outside the US because the market understands that the US is more profitable each 5 to 10 years relative to their competitors. So you need to start to think about, is there really an impetus for change? Or is this secular downtrend in terms of operating margins relative to the US for everybody else just intact? I lean towards that because I'm not seeing any evidence that it's not. And what I see in terms of the dominance of US sectors is technology. Right. So technology, again, not only is in a better valuation setup, but also is in a stronger relative earnings position, given the fact that we've seen this volatility and they've been able to earn their way through. I think that's fairly unparalleled when you look across the globe in terms of sustained, durable profitability. So I do think that the rest of the world, I think over the course of the next year, is going to have a tough time keeping up, especially after the 1,000 basis point relative performance that we've seen over the last 4 months on trade and tariff fears.
There was something about the penny dropping, just when you mentioned what happened in the fall of 2008 and then where we were in terms of multiples after a 30% drop just a few months later in March. I mean, that's
It's odd
That's
that you want to buy
extraordinary.
equities when they're expensive, right?
Right. I mean, which they are. um, Take us a little bit to, just as we close out the bottom three sectors and why they're sitting there. I think we caught up with you a couple of weeks ago, and they might be the same, but tell us what is not in favor.
I do think they're probably the same. So consumer staples, healthcare, and I'll still add in energy. And sometimes I trade utilities, sometimes I talk about energy, but I'll talk about energy because I just had a portfolio manager ask me, yeah, but energy stocks are cheap. And I'll say the same thing about energy. Until we get to more normalized profitability levels, I think valuation doesn't tend to offer the same risk reward that you see in technology stocks or financial stocks. Energy is the only sector where, unlike the math that we just talked about in the S&P, you tend to get trough multiples on trough earnings, meaning that you get that double headwind instead of that offset that you see in other cyclical sectors. Now, maybe you can bet on it's different this time, but that has been historically the precedent. So because 2022 was so strong in terms of fundamentals, and the sector generated so much free cash flow and top quartile ROEs, and in fact, the best operating margins the sector has ever seen based on the data that we have going back to the 60s, we're still renormalizing from that. So I think it's still a risky area. We don't even need to get into excess supply or shales or anything else. But when you just look at the fundamentals, I still think that there's risk to the downside given a renormalization. And consumer staples and healthcare look to be the fact that they are, they were cheap going into the defensive rotation. They're modestly more expensive now, but you could certainly still argue that they're cheap, but they look like value traps to me. Operating margins here have not only peaked, but have been declining. This is a very rare and unusual setup in these defensive sectors. So when you go back and you study history and say, well, consumer staples was offense and defense for quite some time in the 80s and 90s, I don't think that that's true anymore because the parallels aren't similar at all. There's not a lot of pricing power. We saw that in the 80s. We don't see that currently. And I think healthcare is in exactly the same boat. When operating margins are declining, unlike what we're seeing in terms of the technology sector and even the financial sector, that tends to be a value trap, which means that there's not a lot of valuation support to bolster a risk reward.
And it sort of goes the other way for those at the top, where in fact investors may not have so-called missed the boat. As you mentioned earlier, they may well, in fact, have further to go from here for all of those reasons of how we entered it, essentially, or how the economy was set up for it when we entered into that shock. That really was a shock. I mean, it was an on-TV shock to the economy and to probably most people watching.
Right, and I think the valuation reset and tech associated with that shock tends to give us sort of the pause that refreshes in that area of leadership.
Okay. Denise Chisholm, thank you so much for sharing your data with us. It is absolutely fascinating and often points us in the opposite direction to what seems to be the consensus view, and we're grateful for that.
Very true. Always happy to be here.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.